All right. Well, greetings, everybody, and welcome to the April 24th, 2018 edition of the Roundtable. We're happy to have you join us. This is a forum that we've been doing now for nearly 8 years, where we come together on a monthly basis and simply share ideas and perspective. I am joined tonight by my dear friend Ken Kabula. Say hello, Mr. Kabula.
Hello, Mr. Kavula. I'm here and looking forward to this program. I really do enjoy the roundtable. I wish we had a few more nights this evening, but we'll muddle on through if as well as we can.
Yeah, we're kind of stuck with two guys. My name is Mark Robertson, and I'm founder and managing partner of Manifest Investing. And we did expect to have Mr. McManus, but he got stuck in a business conference somewhere on the East Coast and won't be able to join us tonight. So we thought we'd do a little bit of, we've done an awful lot of spring cleaning. So I think it's time to change our perspective and do a little more with spring screening, sources of ideas, just kind of kick around a few things. You can see that the chilled coffee is on the mantle there, along with some makeup and mascara and a little bit of Irish soap. And let's go ahead and get underway. All right, we'll get the legal paperwork out of the way first. No investment recommendation whatsoever is intended. This is all about education. We are here to demonstrate and illustrate the philosophies and methods used by the modern investment club movement as it's interpreted and deployed by either NEIC Better Investing or Manifest Investing. And many of the people in the audience tonight will be part of investment clubs. And again, we center everything that we do on a few key characteristics, and we'll be going over that. So everything is for demonstration. Please do your own homework, and we will disclose when we actually have positions where we remember to do so. Here's our standing agenda. Again, welcome to everybody. A lot of familiar names in the audience, but there's also a few new names. Extra big welcome hug for you. We will spend just a moment talking about the results over the last few years and what we're trying to do. We have a couple companies on the hot seat. Then we'll talk just briefly about three quick screens. Ken and I were in Dayton, Ohio, with the Cincinnati region chapter for Better Investing this past weekend. Had a wonderful day, morning and afternoon, with a wonderful group of investors from that area in southern Ohio. Our selections tonight will be SBUX and Ulta. They are repeat selections, so probably should go pretty quickly. Hugh has a TBD. That TBD would be GE if he were here. So we might take a brief look at that situation. And then, as always, we will do the audience poll after we make our two presentations, and we'll leave the floor open. Probably get done a little bit early tonight, but I don't have a problem turning everybody back on a spring day after the snow has actually begun to melt, even in places like Wisconsin. Here's a quick look at what we do here. The intent is for us to come together and gather and share ideas. In this case, we're trying to present a single decent stock to study that we think that the audience could take a look at and form their own conclusions and judgments and decide about ownership or maintaining the stewardship of ownership. We do try to beat the market. We do keep score. We want to beat the market by 5 percentage points. That's 500 basis points if you speak that language. And we measure that versus the Wilshire 5000. We'd also like to adhere to the rule of 5 and see 3 or 4 selections out of every 5 actually outperform the market after they're selected. Here's our results to date. Again, just quickly going over them. The big number is the rate of return since inception is now 17.5%. That's actually beating the market by 6.4 percentage points. That's nirvana. That's the land. That's the promised land. We want to get there and stay there. Stay in that green shaded area. That red dotted line across the middle is a 5% relative return. That's beating the market with an excess return greater than the Wilshire 5000. Greater than 5 percentage points better than the Wilshire 5000. You can see that we actually broke through that and hope to stay there. We've also seen nearly 3 out of every 5 selections outperform. So again, relative return is simply how well have you done, what's the actual return, minus how well would you have done with a matching investment in the Wilshire 5000. So again, we like being above north of that number. We like being in positive numbers, and it's been a good run so far. Ken, any questions or comments?
No, but it's a pretty graph, and it's a really. I think that a lot of people don't really understand how uh, powerful this graph really is. The kind of money that you can make. I know that my investment clubs run in the +2 to 2.5 to 3% relative return, and that puts a lot more dollars in your pocket over a long period of time. So to beat the market by better than 6 points and to do it over this length of a period of time, that's a really interesting, exceptional thing, I think, for us to demonstrate.
Yeah, and every once in a while we have an Iconics brands or a fossil moment, and they hurt, and they actually hurt the performance fairly significantly. But for every one of those, there's 3 or 4 or 5 or 10 others that have actually performed much better and help us out. Speaking of the outperformers, here they are. For the most part, anyhow. What you're looking at here is the top 20 holdings by percent of total assets. So these will be the 20 most influential holdings amongst the tracking portfolio. You can see all of the various positions by going to that public link up at the top. The legend just below that link up at the top of the page gives you the number of times that each one has been selected. So again, we always start with Cognizant. Cognizant has been selected 12 times. Every time over the last 8 years when Cognizant was voted for or chosen by the audience, we invested $1,000 into it. So $12,000 have been invested in Cognizant, and you can see by the graphic here that it is now worth, again, it's actually been on the uptick again of $25,000, so it's more than doubled. So as you go down that list, go ahead.
Mark, I'm going to interrupt for just a moment. I'm getting a message from one person that she's having audio trouble. If somebody else is having audio trouble, would you write it in the question mark? Because I think that it's just kind of isolated to a single person. But I really need to know if all of you are having audio problems at this time. I'm not getting the messages that I usually get, so I'm hoping it's just isolated to Marie. Thank you.
Yep, and we did remember to turn everybody on this month, so we should
Yeah, we did.
Okay with that. All right, so tonight we will be talking Ulta and StarBucks. So you can see those are repeat selections. Ulta's been selected 6 times. Starbucks has been selected 3. The 6-time selections of Ulta actually show up on this chart as being now worth $8,100. Still looks pretty good, even though it's been selected a few times. So we'll be covering that. Anything jump off the page that you can?
No, but this is quite a portfolio. If you just move down the first 12 or 15 stocks, you have a pretty decent portfolio. And if you're kind of new to this whole thing, you might want to take this presentation and copy down the first 12 or 15 tickers. That makes a great list of stocks to begin to study. And I know that a lot of them are still coming up on some of our screens, which means, in our opinion at least, a lot of them are still in the buy zone.
Yeah, one that's actually been fairly interesting has been Universal Display. That's a 3-time selection, all 3 on the same night. So 3,000 has become 10,000. Not so long ago, that was closer to 20,000. So Universal Display has come back to where it might actually be a more compelling accumulate for those who own it and buy for those who don't yet. All right, so let's go ahead and press on. Here's the other end of the list with respect to, we've actually sorted the portfolio by the return forecast. That's the projected annual return, no different than Section 5 of a stock selection guide. For those of you that are familiar with that tool, it's the return forecast based on the analyst consensus expectations for these companies. And we're going to audit the first 2 at the bottom and take a look, and are they really that low, and make some decisions about that. But again, putting it in the context of the average stock right now is between 7, actually closer to 7.5%. So most of those positions, even though they're at the bottom of our list as far as expectations, they're reasonably close to, in the case of Teva, in the case of First Financial, reasonably close to the average stock right now. Any thoughts on this, Ken?
Well, yeah, Mark, I think that we have people looking at Altisource portfolio right now, ASPS, and asking the question in their mind, why would you buy something with a quality of 8 to begin with? Remember that the quality measure changes over time, so I'm not so sure that the quality was 8, although I do remember when we purchased this that the quality was fairly low. If you look back at the description of the portfolio that we're trying to track, we do allow 20-25% of the portfolio to be in stocks that are not traditional, that don't follow the model. So we tried for 75 to 80% of our stocks to be the good old faithful up, straight, and parallel stocks with extremely high quality that look great on a stock selection guide. But we do have some alternative investments on this list, and Altisource, and for that matter, AZZ, both of them kind of fit into that particular mold. They're a little bit more adventuresome. You could even say that in some cases, people, we regard them as speculative, but we do scatter those throughout the portfolio. We feel that that's good investing advice coming to us from the founder of Better Investing, George Nicholson, who said it's okay to have some frisky investments in your portfolio. It's okay to have some non-traditional, more speculative things in your portfolio. A lot of you don't even recognize the names Altisource Portfolio or AZZ, but if I mentioned Amazon, I would probably have a pretty good bet that it's sitting in a number of portfolios in people that are at this webinar this evening. And Amazon, to me, fits that non-traditional investment kind of idea that Nicholson said you can put into your portfolio without breaking all the rules. Just keep 75 to 80% of your portfolio in these good, solid, reliable growth stocks that are going to grow at a nice, steady pace, a nice, steady, regular pace, and that are going to be the workhorses of the money that you're trying to accumulate.
You know, I think it's fair to say Teva is kind of a turnaround situation. The other one is actually pretty good too. Yeah, and we're looking at a situation where the market average is somewhere around 7.5. We'd like to stay 5 points ahead of that with the overall portfolio. So we'd like to see a gentle boost or a bolstering of that projected annual return for the entire portfolio. Again, we're not too far out of bounds, but we'd love to perhaps discharge the first two and replace it with higher return stocks to boost that up. The quality of the portfolio is excellent. The growth is okay. We were within striking distance of 11%, give or take, and everything else is kind of gravy. So let's go ahead and get underway.
Well,
as far as, go ahead, Ken.
And Mark, it's useful also to remind folks that 6 or 7 months ago when we started some of this spring cleaning, our par value was just around 9.2, 9.3%, something like that. So we've done a fairly decent job of gently pushing that par very close to the sweet spot, to the 5 points above average. And this is just one more small step in that direction. We're not trying to do anything dramatic, but we do like to take small steps in the right direction when you're looking at a portfolio.
Absolutely. It's a marathon, not a sprint. So here's a look at this company known as Altisource Portfolio Solutions. It was a great idea. This is basically a company that contracts out and takes care of residential properties for banks and holding companies that have mortgages. And their business model is basically to take care of the properties and prevent the degradation or loss of value when they sit vacant or nearly vacant. And in a really nasty economic recession or following a bear market, problems in the housing market, this thing fared pretty well from 2007 up to 2013. And as everybody here knows, the housing market has been in a steady state of recovery for the last several years. And that actually runs pretty contrary to this company's general business model as I understand it. Ken, can you shed any light on this situation?
I don't have anything more to say about this particular company, Mark, except that I really don't like the direction of net margins. But the graph that bothers me the most is the blue bar graph on the right on the bottom. That's trying to set a good solid average PE, and those bars look like pipes in a pipe organ gone bad. I know that we've drawn a trend line on it, but at the same time, I don't know if there truly is a trend in what those bars are doing. And that makes an analysis extremely difficult, whether you're using a traditional SSG that calls for an average high and an average low, or whether you're using a slightly different business model that calls for you to make a determination of the average PE. Both of them are going to be difficult with PEs that are doing what the PEs have done for this company for the last 10 years or so.
I do want to say that if we take this company out of the portfolio and sell it tonight, I'm going to put a for sale sign in my yard, because as experience has taught me, anytime I make a decision like this, I can count on the value of my home beginning to plummet with some type of a economic strife or something. So I don't know. Just kidding. I hope. Here's the other one, and this one's actually quite a victory. It's up about 30% from the time of selection. They make electrical stuff for transmission and distribution. It's a fairly formidable company, but they also have some interesting challenges on the demand side of things and some of the competition. In fact, even with General Electric, where the overall demand for electricity is going down, and or certainly down at a lower pace. But in this case, the economic challenges and everything are fairly clear. The flatness of that line across the top, earnings have been slightly non-responsive there towards the middle of the graph. Margins have been compressing. So I think we just take the money and run on this one. Any thoughts, Ken?
No, absolutely. When you have something that you've made good money in, and now the fundamentals are at a place where you probably would not choose to add to the portfolio more of that particular holding, it doesn't serve any purpose to hold on to it because it treated you well in the past. A stock has to be, what have you done for me lately? And this particular one has just kind of languished in the last 2 or 3 years. We probably didn't pull the trigger fast enough on this one. That flat sales for the last 2 or 3 or 4 or 5 years, the price bars that have kind of been stuck in a very narrow range, and that earnings line that for 2 years at least was trending down until it popped up a little bit in the very last fiscal year. So all in all, I think it's a good thing to sell this very small position. The two stocks together that we're looking to jettison from the portfolio only give us a little bit more, or a little bit less, I guess, than $2,000. So we haven't, it's not like we're making scads of money on either of these. We lost quite a bit on the first one, and this one has gained a little bit to help us offset that loss.
Mm-hmm. So again, the portfolio does need a slight improvement. If the portfolio was fine, might be a little bit slower on the trigger with AZZ, but especially depending on what the 2019 projections come out and actually look like. But for now, I think it's just a little bit more spring cleaning. All right, so with that, we'll go ahead and transition into a couple of screens. This is a screen that we'd used in the Dayton program. We use all the time. It's the ivory soap screen that many of you have heard us talk about. I present it fairly often here. And what this really comes down to is we know that the analysis of any company is really centers on two results. And those two results are the return forecast, that's section 5, projected annual return, that's on this table as the par in the far right-hand column, and some measure of quality. At Manifest Investing, we actually break that down following the teachings of George Nicholson and Benjamin Graham into that 4-component quality rating or ranking based on financial strength, earnings predictability, and then relative growth and profitability versus peers and competitors. And then we rank them from 100 to 0. If a company is in the top 20%, Anything above 80, we've color coded in blue, and you see all of these companies meet that. So what you're looking at is going into manifest investing, looking at that composite manifest rank and entering that 99.44 for Ivory Soap, 99.44% pure. So you're basically looking at the top one half of 1% of the opportunities based on those two important characteristics. So from top to bottom, that's a pretty good shopping list with very few exceptions. Ulta jumped off the page. A lot of you guys have actually written to me over the years and say you never take the first one, Mark. So I'm going to take the first one tonight. What do you think about the list, Ken?
Well, this is exactly where I went to start my search as well, Mark. I ran a couple of different screens after this one. My stock, which is StarBucks, kept coming up on the screens that I was looking at. One of the things that I demand and that would have crossed off a few of these on this list is I really am looking for a nice, strong EPS stability and a nice, strong financial strength number. I want them both to be 80, 85. If I can get financial strength up into the 90s, I'll take it with joy. And I think that kind of is why I moved all the way down the list to StarBucks here. As you go down the list, Mark's putting red lines through some of the ones that probably left because of these constraints that I placed on myself. I really like the idea. Mark and I talked about the idea of the Canadian food retailer, Aliment Couche, Couche-Tard, and this is Circle K in the United States. They do trade on the United States exchanges as well as on the Toronto Stock Exchange. And so I kind of thought, well, let's take a look at that one. But then I looked at financial strength and earning stability and said, no, I can do better. So you can see why I settled on StarBucks. Those are two great numbers. And I will tell you that one right in the middle of the chart, CVS, all the numbers look wonderful. But I'm afraid that I'm classifying CVS as one of the rule of five stocks, at least from my experience. I've played around with CVS now for 4 or 5 or 6 years. I've made virtually no money in it of any kind. CVS keeps changing its business model. I understand that they're trying to stay relevant and they're trying to create something that doesn't have a lot of competition from an Amazon or something similar. But I skipped over CVS just figuring that I could do a bang up stock study on CVS, and with the way that it's been going, that I wasn't going to make any money on that stock. So that brought me all the way down to StarBucks, although I did seriously consider Ulta Beauty. I guess I didn't pick Ulta because I've chosen it 3 or 4 times in the past.
Okay, and there's only 2 other numbers I would point out that when I'm selecting from a shopping cart of stocks like this PE of 46, an average PE in the future for American Tower, and then actually even either one of these two just give me a little bit of pause. Again, I tend to think of it as that is the PE that has to be maintained in order for the return to be achieved. Again, kind of like an Olympic high jumping event. The degree of difficulty is pretty stiff, and any compression in that makes it harder to achieve the return over the long term. So again, I wouldn't rule them out completely, but when I can find a similar situation with a PE at a fraction of those numbers, it's just a little easier to sleep at night, I guess is the way I would frame it. So we're gonna.
And Mark, you can get really picky on a chart like this too. I will disclose that in one of the 3 portfolios that I manage for our personal life, Natalie and I own 8 of these holdings, and we don't hold more than about 17 or 18 total stocks in those 3 portfolios. So to own 8 off of this list says that this is a pretty high class list.
Yeah, it's a good list. And the one other one we didn't mention, Alliance Data Systems, was also almost my choice. They just had a quarter where they reported, kind of lukewarm results, and then did a little bit of foreshadowing down or guiding downward. So they've actually taken quite a hit, but it's Eddie Elfenbein favorite and a pretty good looking system. Here's another one just to see if what pops off the chart. And all this one, it's a bit of a tribute to the Morningstar price to fair value. The Morningstar fair values for these 20 stocks are on here. And for anybody out there that has heard somebody complain that there's nothing out there to buy, these are all excellent quality companies or borderline excellent quality companies that are trading at a fairly significant discount to their fair value. And then that number is shown on the far right-hand side. So again, CVS Health is seen by the analysts, especially at Morningstar, as fairly significantly undervalued. I hear what Ken is saying about the changing business model, but the healthcare arena is just simply a zoo anyhow. And at some point, CVS just continues to churn out fairly decent results and pretty impressive results considering the challenge that they face. And I know since we buy some medications there that they are not cheap. McKesson was presented last month. There's just a number of companies on here that are worthy of running up a study flagpole. Anything grab you, Ken?
Well, one of the most successful stocks that I've ever owned in one of our investment clubs happens to have made the list this time. That's NetEase. It's a Chinese company, so trust but verify as far as the numbers are concerned. The Mid-Michigan Model Club, this is the best performing stock that they own, and we've owned it for 8 or 9 years now. So it's coming up significantly undervalued according to Morningstar right now. With that 77% is a fairly low number for price to fair value as far as I'm concerned. That's a pretty good par number, maybe a little bit too good. Mark and I have been kind of watching this one for a couple of years, and we noticed that a lot of times the analysts don't know what to make of this company. And the analysts' projections kind of swing like a pendulum from being very, very low to very, very high. And I think that's because they're not quite sure what the next step is. You get very little guidance from these Chinese companies or from a lot of the ADRs, and to be honest. But NetEase, I think, has a history, at least with me and my investment club, that we're trusting of the numbers, and we believe it's a great long-term holding. Like I said, it's the best investment that the Mid-Michigan Model Club has ever made.
Good stuff. It's interesting to see an electric utility show up on there too. Dominion Resources just a couple notches down from NetEase. So again, these are certainly within the realm of potentially being in a buy zone. And the last screen I thought we would share is kind of a tribute to our Irish colleague. We've referred to this as the Irish Spring approach over the last couple of years. Not Ivory Soap, Irish Spring, because McManus just loves to find a company that he has pre-qualified or vetted. Typically, those companies are going to have very strong quality rankings, but he also likes to find them trading fairly close to their 52-week lows. Now, I did not restrict the list to solely excellent or good companies. I left a couple in there that are potential turnarounds. I think it'd be fascinating to get Hugh's input on Insight. INCY keeps showing up on a number of lists, but you can see all of these companies are within pretty close to striking distance on the 52-week high. 52-week low. So from top to bottom, there's actually some fairly interesting potential studies there.
Yeah, for those dividend investors in the house, Procter & Gamble just kind of shrieks at me, and it's sitting right below Pepsi, which is also kind of screaming at me if you're looking for a decent dividend.
Yeah, and you're talking about, again, a double-digit return against a 7% average stock, so not the end of the world. The tobacco stocks have gotten crucified by some of the recent news that ends up with Altria showing up on the list down here, MO. But again, just 3 different screens, scouring for the types of ideas that we typically try to find, and you can go pretty much in any direction using the three screens, whether you need a little bit more growth, maybe it is time for a gentle speculation. Um, there are some interesting ideas on here.
If you're using the screeners on the SSG Plus tool, and if you're using the quality screener, the preset screen for quality, or the preset screen for value, or the preset screen for small companies, you'll see Regeneron coming up time and time again. Has a high quality ranking in the manifest system, 77, and it's within 1%, or just a little bit more than 1% of its 52-week low. So there's another one that might have a lot going for it when you look at the kind of model for the companies that we're interested in, this up, straight, and parallel idea of nice, consistent growth in sales and in earnings.
Yeah, and for the last several months, I've shied away from them, but I keep seeing Regeneron and Celgene, and might be an interesting study that we'll tackle in an upcoming month. So with that, let's turn our attention on caffeine consumption. And Ken, why don't you take us away with
Well,
Starbucks?
before I go to the first slide, I want to say that I prepared myself when I went to Dayton to the Cincinnati chapter, the OKI chapter. I prepared myself for some discussion of Starbucks, and we had a little bit of it going on. And I knew there was going to be a question about all of the happenings at the single Starbucks location, where two African American men were denied the ability to sit in that restaurant and wait for somebody for a business meeting, and they didn't buy anything, and they asked to use the restroom and were asked to leave, and the police were brought in, and it became kind of ugly, and then it became a cause célèbre as far as the television networks were concerned. The question was, do you think that damages Starbucks in the long run? And my answer is, I don't think that it does. I think that Starbucks moved aggressively to make it clear that that was not something that they condoned. They moved aggressively to bring some training into their entire system of stores throughout the entire world. They actually shut the company down for a period of time to train their workers in some of these things that sensitivity and racism and some of the other things that go into that whole incident. But when it all is said and done, I think that this is a problem with a particular manager that was maybe being way too aggressive as far as following through on certain rules that might have been laid down. I don't think that any of these rules came from corporate headquarters, and I don't think that Starbucks has a history of institutional racism in any way, shape, or form. It consistently ranks on the lists of the most admired companies in the world, the best run companies in the world, and I don't feel that this is a problem that has any real staying power to it, as long as Starbucks addresses the issue and makes it quite clear that it's not going to tolerate this kind of behavior moving into the future. With that said, let's look at some facts about the company, okay? First slide, Mark. You can see the growth that's been going on, and one of the things that I always look for in a company that I try to buy is I want to know how they're going to grow in the future. They've grown from 18,000 stores to 28,000 stores in the last 5 years. That's pretty decent growth. Just that store growth alone is going to add 9-10 points to the growth story as far as revenues are concerned. You can see that they've added 50% more customers to their customer base, and that their revenues have grown better than 50% over that 5-year period, and their market cap has reflected this kind of growth, because you don't only get growth in a retailer from store growth, you also get growth from same-store sales, and Starbucks has managed to move same-store sales in the right direction most of the time. Next slide, please. I'm looking at their long-term financial targets, and I think it's important to hold a company in future years to what it says it is going to try to do in a particular year. So going forward, they're going to try to maintain same-store sales at 3 to 5% growth. That's pretty aggressive, but they've been able to do it, not consistently, but they've been able to do it on a fairly regular basis. Their consolidated net revenue growth, they're going to try to move into the high single digits. To me, that's 8, 9%, something like that. They're non-GAAP, and that's important for us to understand the language. GAAP is what's reported to the SEC, generally accepted accounting practice numbers. This goal, this target is in adjusted numbers, and they're looking to grow their adjusted EPS at 12% or greater. But 12% is they're willing to put right on paper. And when a company is willing to put a number on paper, you can reason through that that's probably a fairly conservative number that they're pretty sure they're going to be able to succeed at hitting. Their return on invested capital, that's what ROIC stands for, 25% or greater. That's not exactly the same as return on equity, but it's close enough. And that's a pretty decent number. And they'd like to return $15 billion to their shareholders long term. They don't exactly define long term, but if you read through this presentation and listen to the dialogue that goes with this presentation, you'll find out that they're talking in the 3 to 5 year time range going into the future. Next slide, please. This is something that I didn't realize, that Starbucks now sells as many cold drinks as they sell hot drinks. 5 years ago, a little bit more than 1/3 of the drinks being sold were cold, and the rest was coffee and tea. Today, half of all drinks going out into the public being sold at a Starbucks are cold, and it's an interesting fact that cold drinks tend to have higher margins than hot drinks do. They can sell them for more, and they can tend to make more money on it. Next slide, please. Here's one of the biggest, fastest growing cold drinks that exists in the world today, and that's cold brew. Right now, cold brew, and this is not cheap. Go to a Starbucks, order a cold brew, you'll discover what I'm indicating about not being cheap. Presently, it's available in 28,000 of the Starbucks stores. Click again, Mark. Next slide, please. And I'm sorry, back that up if you would, okay? There are 28,000 stores in the Starbucks system. That's what that number means. Now go to the next slide, please. Right now, you can get this nitro drink, this cold brew, in 2,300 of the stores in 27 countries. And by the end of this year, they expect to nearly double that number to 4,000. So here's a huge growth driver, this cold coffee. It comes in a beer tap, looks sort of like a beer tap. And they're going to go bring it into all 28,000 of their stores going into the future. By the end of 2018, only 4,000 of the $28,000 will be equipped to serve it. Next slide. This is also a fact that I wasn't aware of. Even though I'm the stock watcher for Starbucks in one of my clubs, I did not realize the quickness at which their food business was moving. I had reported a number of times that they were focusing more and more on food and looking for food, not only a breakfast type food, but looking for food that would serve people a lunch, a late lunch, even a quick dinner of some sort at a Starbucks. They expect to double their food business by 2021. That's a great target to measure when 2021 gets here. Next slide, please. Today, 3,200 stores in China. By 2021, 5,000 stores, so more than 50% growth in the next 3 years. They're in 139 cities right now, moving to 200 plus cities, serving 6.4 million customers a week in China. China now has the largest group of people with middle-class disposable incomes in the world. They expect that the Chinese economy will surpass the U.S. economy in 2021 or 2022, but already consumer spending by the middle class in China is greater than it is in the United States. And China, the people right now are minuscule coffee drinkers. They drink almost no coffee at all. And Starbucks' goal, obviously, is to turn them on to fancy coffees. If they can move the consumption of coffee in China even to a quarter of what it is in the United States, then they will be making money hand over fist. Of course, there's always the issue of competition, but there's not a lot of intellectual property involved with making coffee. It's just making sure that you have a good customer base and that you treat your employees fairly decently. And Starbucks is working very hard to establish itself as the coffee shop in China that you go to. Next slide. I'm looking here at a screen capture from the SSG Plus. Sales, certainly there's nothing to worry about sales. Notice that I've eliminated the year 2013 from the graph. There was an adjustment that needed to be made to the data in 2013. The graph dips way down because of a legal issue that was paid, and then it goes back to trend in 2014, and I've just handled it because it's fairly old now. I've just handled it by deleting it from the graph and letting the trend go from 12 to 14 without too many problems. That most recent quarter is going to have to be adjusted. Starbucks is gaining from the new tax law some money, and the most recent quarter doesn't look nearly as good as that graph is showing you. My trick right now, when I have a quarter that needs to be adjusted, is to do my estimation going forward. I usually estimate from the most recent quarter, but in this case, I changed my start point, and I'm estimating from the last piece of fiscal data. You could also choose to estimate from the end of the trend line, whichever way makes sense to you. They both will give you a reasonable end point 5 years from now. And remember, that's the number that transfers to the back of a stock selection guide. When I finish this SSG, I get Starbucks in the buy zone. I get an upside downside of about, it's not on here, yes it is, 7.5 to 1, and I get a par value of about 16%. Next slide, please. Here's the chronicle coming from Manifest Investing for Starbucks. I won't buy a company where quality is moving in the negative direction. A couple little blips in the quality rating back around 2016-17, some of it having to do with the tea business. They tried to move aggressively into tea, found out it wasn't working, and then unloaded that business as part of the major thrust for the company. But quality seems to be back online and actually seems to be a little bit higher now for the last couple of years than it was before some of those machinations were going on. What's especially interesting to me, however, is that red line. And that red line is showing me par, and I'm looking at a par value at the end of March, which is very similar to the par value I just calculated. And it's a historically high par value for Starbucks going back about, I don't know, 5 years or so, 3.5 to 4 years. But that red line is as high as any other red point that it's being displayed on this particular graph right here. So a nice consistent quality rating up near 100, a par value that's as high as it's historically been in the last 3+ years. Those are two real positive things for me to look at when I'm deciding whether I want to buy some more of the company or not. Next slide, please. Here's from Value Line. I'm noticing that their low total projection is about 16%. Well, that's sitting right smack dab on my own par value. Manifest shows a 16, I'm sorry, Manifest shows a 15 par. My SSG was 16.1. Value Line was 16 at the low end. I think that I'm coming up with a number that's showing consistency and that I can have some belief in. My SSG was based on growth rates of about 10% for revenue and earnings. That 10% matches the Value Line number, but that 10% earnings growth number is considerably less than where Value Line thinks the earnings are going to go in the next 3 to 5 years. Value Line is showing 15%. So if they do 15, that's only going to be to the good for my SSG. That'll just add more to my par going forward. I don't see anything that doesn't kind of fit together very nicely, and that doesn't tell me that this is a pretty decent stock to make a choice on right now. I should also note that the safety rating for StarBucks, I knew that from Manifest looking at its financial strength, but that safety rating up in the upper corner, I don't read timeliness, but that safety of 1 up there certainly gives me some feeling, nice, safe, huggy feelings that everything is going to be fine for me, that I don't have to worry too much about reading that the company's gone bankrupt or anything like that. Next slide, please. And here I've captured the top of the StarBucks page. Quality of 98, I already showed you that in the Chronicle. Par value of 15%. Sitting almost exactly where we suggest that the par values usually sit, right around somewhere around that low estimated value for Value Line. And then I like also to look at the quality rating numbers, the raw numbers that go into the quality rating. I like to see 4 numbers that are pretty uniform and that are contributing equally to a nice high quality number. Well, if it's the quality's at 98, the raw score is at 84, and what that means is that 84 quality points, and you're getting them from those 4 categories, is better than 98% of the companies in the database, and the database contains about 1,500 different companies. So I really like these 20s and that one even almost near 25, which is perfect for financial strength. So all in all, I'm going to add StarBucks, and I don't see too much wrong with it that I don't understand going forward for the company.
Okay, thanks, Ken. I find myself wondering how much of that $15 billion my daughter contributes. Hope you did have one more. Just
Caramel
about
macchiatos, right?
Yep, she's a.
I just captured this screen right here just to show that in the fast food restaurants, and that's where Starbucks is usually classified, it shakes out on top. That's Shake Shack right beneath it right there. McDonald's is the 4th one on the list. So Starbucks, it seems to be the best company in that fast food restaurant, and it's also sitting as one of the best in the whole consumer discretionary category, only surpassed by Edu, and I'm reasonably certain that's a Chinese education company, although I'm not for certain on that.
It's for-profit.
There's Mark's Ulta Beauty. It's a for-profit, right? Yeah. And there's Ulta Beauty sitting at the top of the list. So companies that we really like, LCII is a company that we've talked about a number of times fairly recently. So this is always very helpful on Manifest for me to see where my company kind of ranks after I make a choice for it.
Well, what a nice segue, and I'd forgotten you done this. That you basically have set up saying that in this particular sector, Ulta has the highest ranking, and I think that's important as people form their conclusions tonight.
he's he's begging for votes, folks.
All right, this is a company that is no stranger to most of us in the audience. Many people hold it. Ulta Beauty ticker symbol is ULTA. It's a true up, straight, and parallel with a little bit of a flat spot on the right hand side when it comes to the stock price. But the company's fundamentals have actually been hanging in there pretty good, and we'll go ahead and talk about it. I got to admit, I'm not real comfortable with in person research on this one. I have to rely on other people in my family to tell me what to think about some of the stuff. And I know Ken has also used the adventures of his wife and granddaughters to experience this company because I don't think we're getting any firsthand experience there, are we, Ken?
No, no, there's very few products that you can buy as a male, but it's quite an adventure to walk into an Ulta with your granddaughters, though, Mark.
I do. I have walked in. I didn't get more than about 10 feet in, but that's the way we go. So again, I'm going to rely on daughter and wife, and they say good things. But then just today, an article came out that is presented by a young lady by the name of Jessica Tyler, who actually has pretty good credentials at the BusinessInsider.com business publication. And she actually went out and she taught me about this company called Sephora, which is apparently a fairly direct competitor to Ulta. And they actually went and visited stores on the Upper East Side of Manhattan, comparing the two side by side. And as Jessica says here, the winner's actually fairly clear from a consumer experience standpoint. And the basis for that conclusion, you can actually go to Business Insider and check out Jessica's work. A lot of people have. You can see almost 1.9 million people have checked it out. So it's a fairly hot topic. But the other one's a higher level, more prestigious company that does the Moet and Louis Vuitton type stuff, much higher price points, smaller selection, whereas the Ulta is characterized as appealing to a fairly broad spectrum of economic choices. You can buy products there in single digits and $20 and $30, and at Sephora you didn't find that same type of thing. So in terms of consumer choice and covering all the bases, including the services that are embedded in the salon, etc. She actually liked that one. Um, Ulta is opening new stores, while a lot of the retail segment is having trouble, and they're actually closing stores. She went on to differentiate a little bit that many of the Ulta stores are freestanding. Ken has told us about that in the past in the strip malls, whereas some of the competitors have their stores embedded within shopping malls, which are having some fairly decent challenges. So that separation seems to help them quite a bit with the traffic and the consumers. And again, here she's pointing out that Ulta does carry luxury and drugstore brands, so you have a spectrum of choice when you're working with Ulta. And again, Sephora, pretty much a luxury brand situation. So they went out, and you can actually go ahead and do the tour of one store versus the other. And, like I said, I get 10 feet in and I get scared, so I basically quit at that point. But here's what we're looking at with Ulta. Again, this is a multiple time selection, so we've seen it a number of times. A couple of things I want to point out between the October 2017, and I think we had done some of our selections back in that time frame, and had a couple accumulates between now and then. Um, what we are basically seeing and will be reflected in the next update is a little bit of a plateauing of the sales growth. Now, that's not end of the world type situation, but as you look at the right hand side, looking at what's going on here, there is a general flattening going on. Whereas this has been 15 to 18 to 20% growth for years, it is starting to get into that more mature phase where 12% is probably a more reasonable number, and that 12% actually represents the the trend that's inside that bubble. Most recent couple of years and looking out into that 3 to 5 year according to value line. So again, the 12% is not bad. It's not end of the world. It's a natural thing, but it is happening. And if you actually chart the new store growth, as Ken was talking about for Starbucks, you'll find that historically they had a 12 to 14% store growth pattern back during this time frame, and they've shifted to more of about a 7% per annum. So again, there's a kind of a stake in the ground. Still a very healthy, very robust amount of new store growth, but not what it was. So that really should be accounted for in the overall expectations. So with a sales growth of it's about a $6 billion company with sales at about 12, we are seeing increasing profitability in terms of increasing net margins over time. They probably get some tax benefits from the accounting adjustments that were just made, but this is a fairly positive picture that many of the analysts who follow the company believe in. So we are seeing a very gentle uptick in projected net margin, the profitability of the company. With the slowdown, it's pretty natural to see a little bit of a slowdown in the PE. The PE is ramping down a little bit. So the consensus has moved from the mid 20s to the low 20s. Again, not end of the world, but it does affect the numbers a little bit. So the gain in the top line here, along with the slightly moderate more sales growth at 12%, a little bit better profitability, and still a very decent PE, leads to a very credible return forecast in the 12 to 13% range. And again, that's more in line with this low return forecast offered up by Value Line. So again, I look at a very positive situation, a very controlled situation on the growth of the company, and pretty good situation, and I recommend that we accumulate a few more shares of it. One of the other things that we wanted to point out is that, even though the company has been fundamentally steadily improving, and we see this all the time with our stock selection guides, the stock price has taken a setback. I believe the all-time high in stock price was about $315, set during 2017. It dropped all the way down to the 200 range. It does look like we are putting in a bit of a support level down here, which is a good thing, kind of to keep it from going lower. And it has been fairly steadily improving over the last several months, as shown here. It's moved from 202 back in October to 233, 234 recently. So it's actually bouncing back up a little bit. And I think that's a fairly solid support level. And again, going back in history, this type of thing happens to this company. You don't only have to look back a couple years to see another type of situation here. So again, nothing unusual, fundamentally sound. That same picture that Ken likes to look at, I also like to look at. I see improving quality. Again, that stems from the favorable growth pattern over time in combination with improving profitability. It's getting financially stronger, better balance sheet as the time goes by. And again, with the fundamentals improving and the stock price doing this that we see here, and as we saw in the previous graph, the return forecast is now going to be in the mid-teens, and it's at multi-year highs. So again, both of our selections tonight look pretty favorable when it comes to this position, and they're pretty common destinations for a number of people, including our wife's daughters, granddaughters, and friends. So with that, we'll go ahead and just give a nod to General Electric. If he were here, he would be picking General Electric. We're not even going to include it in the poll at this point, but he is still maintaining his stubborn Irish mode. And the company has bounced back a little bit from the bottom, down around 12 or 13. And it did bounce back a little bit on rumors that Berkshire Hathaway and Warren Buffett were interested in buying. And again, it's fallen far enough now that it has reached a fairly significant oversold condition. And if you can again, in the Hugh McManus tradition of hold your nose and invest with conviction, who knows? Could be better days ahead for GE. And there's his catchphrase from last month: they bring mood swings and strife to life. So with that, Ken, I think we can go ahead and run a quick poll. Hopefully Ken is still with me.
I am. Can you hear me?
I can hear you, and
Okay, and I'm just getting
sipping
all
on
the
that
buttons
latte.
pressed, and there I've launched the poll, and I'm waiting for our folks to vote now. We're up to 75% voting, 80% voting.
Quick on the trigger, guys.
Yes, they are. 90% voting. I'm going to count to 5 in my head and then turn it off. We had 93% voting, and let's share the results. And it was a beatdown, Mark.
Oh man,
Okay.
a lot of coffee drinkers out there in the audience, apparently.
So we're gonna drink some coffee. Although we did have a fair number of folks not like either one of them tonight. We didn't give our audience enough choices this evening,
Well,
but we'll try to remedy that. And for our next round table, if we can find out early enough that we're going to have some holes, we'll give some of our friends a call. I noticed that we have Susan Michelik in the audience, we have Herb Lemkel in the audience, we have Nick Strategos in the audience. So we'll try to get some of those into our roundtable here if we're going to be short next time.
a number of them are going to join us for the live session at the National Convention in Orlando too. So
Absolutely,
we'll have
absolutely. So let me shut this down here, hide it. There we go. And then I promised my friends in Charlotte, North Carolina, the North Carolina chapter and the South Carolina chapter are trying a joint investing day in the end of October, October 27th. And Natalie and I are going to be traveling to Charlotte on that day to present some really great things. If you're anywhere near Charlotte, North Carolina, we'd love to have your attendance at this event. It's the first time they've tried a joint venture in Charlotte. Charlotte hasn't had a better investing event in over 10 years. So we're trying to bring some people into one of the fastest growing cities in the country. It's a vibrant, beautiful city, and if you've never visited Charlotte, now might be a great time to put it on your agenda. I also want to plug Cy and Mark going to Atlanta in August. That doesn't sound quite as nice, Atlanta in August, but at the same time, Atlanta's putting together
Chris, come on.
They're putting together a great educational day down in Atlanta, and while they're going down to Atlanta in August, I'm going to go to Heart of Oklahoma, Oklahoma City in August at the same time. Maybe not climate-wise the best time to do it, but Oklahoma City, the people are warm and wonderful. The city is beautiful, and we're going to have just one heck of a Investors Day down there. So we're giving you plenty of notice on those 3 events. We'd love for you to come to one or all 3 of them for that matter if you can travel around with us. But come to one if it's close to you. We have a great time. It's very loose, informal, and we do a lot of laughing. So we'd be happy to see you there. And then, of course, Cy and Mark and myself are going to be at the Better Investing National Convention in Orlando from May 17th through the 20th. We're going to do a roundtable live down there. I'm going to do a ticker talk live. We're going to have beginners classes. Mark and I are going to talk about selling. We're going to do 2 guys talk stocks. So come on down. There's a lot of good things, and we're only a small part of the program. There's a large number of classes. They're really great classes, and they go Thursday night, all day Friday, all day Saturday, and Sunday mornings. So come on down and see what there is to see in Orlando, okay? Mark, if we're done with the primary program, I do have a few questions for us to clear up.
Sure.
But maybe you want to stop the recording and then we can go into questions, okay?
Yeah, we can do that. Shortens the recording time. Well, thanks everybody, and we'll go ahead and move to a little extended Q&A. This is the after session beginning.